Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's December the 20th, 2018. And so we are drawing to the end of this year. And it's been pretty choppy in the market, so I thought I'd do another update sort of mid-month. So let's go through a small handful of slides here, and let's talk a little bit about what's going on in the market and how we are positioning ourselves. So the first slide is a disclaimer. As you know, we have to cover off our legal obligations, and so you've got the disclaimer slide. Now on the next slide, just a quick outline of this particular presentation. First, current market update, and I just say here, take a deep breath, but don't forget to exhale, because this too will pass, and all market volatility, whether it's up or down, provides opportunity. Number two, the Fed lifts interest rates. Yesterday, the Federal Reserve actually increased interest rates again, fourth time this year. And this has got the market somewhat worried. Although the yield curve, and I'll come back to this in a second, really isn't buying it. Even though the Fed is increasing the rate, the short-term rate, the yield curve, which gives us the interest rates across the sort of the whole 30-year spectrum, actually came down yesterday. So the market's saying, well, you know, we're not buying this interest rate increase. We think it's going to be pretty tough, that there's probably a slowdown in the economy ahead, and the Fed's going to have to reverse course or at least slow down significantly. Third, areas of opportunity where we're continuing to focus. And then just an exhortation in terms of the fourth point, we stay focused on the playing field and stay focused on the long-term opportunities in the market and try not to get waylaid by all of the news out there. So let's go through the slides here. The next slide, just to give you a sense of what's happened year to date. This is as of last night, so the 19th. You can see the TSX is actually down 12% year to date. What's interesting is the TSX, in terms of the total index value, now this would not include dividends reinvested, but just the index value, it's actually below the level that existed back at its high in 2008. So it's a pretty sad situation in terms of wealth accumulation in terms of the TSX. Second, the S&P 500 now is down 6% year to date, and that was the outstanding market along with the NASDAQ, because global markets have been down, by basically the whole back half of the year. But the U.S. market's been more robust. The NASDAQ is down 4%. The FTSE, which is the UK market, with significant global assets there, also global businesses, is down 13%. And the German market, again, just to give you a flavor of a European market, a big European market, is down 17%. And that would be heavily weighted with a lot of exporters, auto companies, big manufacturing, engineering companies, and so on. On the next slide, you can see that the China market has taken it on the chin. It's down 23%, Hong Kong down 14%. Japan, which had been holding up quite nicely, is now off 10%. Oil is down 21% year to date, but the number that's really shocking is if you take the closing price on October 31st, it was around $76, and it's now around $46 today. That's off 40%, basically in, you're talking here, a month and a half. So big drop in oil, which a lot of people are saying, hey, this is an indication of slowdown to come, be careful. And then gold's off about 2%. It's actually up a fair bit today, but gold's been hanging in there, which is pretty good because the US dollar's been quite strong globally, and that means the gold is priced in US dollars, so it's been very strong this year. The Rocklinc portfolios, and this is going to vary. We actually have some accounts that are being managed for specific legal reasons, endowments and their professional insurance portfolios and so forth, and those are managed slightly differently, very conservative. Those actually might be up 1% or 2% still, but generally most of our retail accounts will be down maybe 1 to 3% this year. So we are hanging in there very well. You never want to go down, but it has been a brutal market and a very difficult market. So we continue just to focus on, okay, how can we use this to our long-term advantage? Because that's the whole point, right, when you're investing. The next slide just talks about Feds lift rates. That's the Federal Reserve in the States. We aren't seeing rates go up anywhere else in the world, just in the United States, of course, and this is sort of irritating the markets. This reduces, and they also reduce their expectations on future rate increases. So yesterday when the Fed increased its rate, it said, hey, looking into next year, instead of doing 3 rate increases, probably 2. And our best guess, and I think what the market is saying is, you know what? You'll be lucky if you get 1 increase next year. In fact, you might even be lucky if you get any increases. So we just have to stay tuned here and just see what the Federal Reserve does. The Bank of Canada, as you know, has stayed pat and has not increased because they're very concerned about the weakness in the Canadian economy, and largely as a result of course, the oil being very weak. And so on the next slide, well, just a second, on the back half of that slide, dealing with the Fed increases, you can see what's happened here in terms of the Canadian government 10-year and the U.S. 10-year, that over the last 30 days, the Canadian 10-year has actually backed off 39 basis points. That's 0.39%. And it's only up 2.5 basis points, which is like 0.025% over the last year. So basically, all of the enthusiasm about rates going up in Canada in terms of the 10 years come right out of the market over everything that was in there over the last year. In the United States, it's still a little bit higher because their economy is growing more quickly, but you can see that the 10 years at 2.77, it's down 30 basis points in the last month, and now it's only up 27 basis points over the last year. That used to be at its high, over about 80 basis points increase, almost a full percent if you go back a couple of months. So we've had a large drop in interest rates coming down, even though the Fed's been increasing, and that's a very important point because it means the market is concerned about long-term growth. Then on the bottom there, I just say flattening or inversion continuing. That means when the longer-term rates are actually at a lower interest rate than the short-term rates. You call that inversion. And you can see that the U.S. 5-year rate is actually 2.64, and the 2-year rate is 2.66. So you're saying, I'm going to get a lower rate for going for 5 years than 2 years? What's going on? And that's because the market's saying it's going to be difficult for long-term rates to go up. They're seeing that rates are actually going to have to come down and that the Fed is being too aggressive. That's really what the market is saying. And so we're going to keep our eye on that. On the next slide, what's driving all of this? We talked about this in our previous update, so let me just go through these quickly. Concerns over slowing growth, and we are seeing that in many parts of the world. High debt levels, the impact of interest rates going up in the U.S. in particular, and they've been what they call quantitative tightening, so they've been taking money out of the system. And that, of course, is going to take a little bit of that drug out of the market, that excitement, and that's an issue. Trade frictions, high valuations in the stock market already. A lot of those have now been taken out, so there's much better valuations, but we're coming off highs. Political pushback against sort of global elitism and unrest. We see this in many countries around the world. That's also can be destabilizing to the markets, along with lopsided headlines. I just warn you, be very careful of the headlines. Everybody is just trying to sell page views. And so, you have to really look through the headlines into the substance of what's taking place. The next slide, in terms of areas of opportunity, our companies continue to do very well. That hasn't changed. In fact, they're generating lots of cash, and most of our companies are growing at very nice pace, faster than the GDP. Precious metals, we think, are very cheap. Today, they're up a fair bit. They have been doing very well the last couple of months. We do think a lot of the pressures in the economy will put an upward bias on the precious metals, and the companies that we own in this space will continue to do very well and make a lot more money and have a lot more upside, even if the broader markets come down. And that's important because they're a hedge. Large dividend-paying securities have just been taken out and beaten up behind the shed, so to speak. I mean, a lot of these companies, some of the Brookfield companies, some of the real estate companies, they are very cheap and they're giving great dividends. And so we just pick away, take advantage of the cheaper valuations. They are not going out of business. In fact, a lot of them are continuing to grow at quite nice pace, and we could even see dividend increases in the next year. Nibbling on some of our favorite companies, and then of course actively investing and actively talking and researching a lot of new potential companies that we can invest in. The last slide, stay focused. You know, the negative sentiment is actually a good thing. The more negative people are about the market, the more opportunities there are. The more excited people are and the more optimistic, hey, there's virtually no opportunities. So from our perspective, we invest through the negative sentiment and find good opportunities. Disciplined value approach. Valuation risk is a big issue, so the risk of what you pay, and we're trying to be as careful as possible with what we pay. Quality risk, we're sticking to the highest quality assets. And then portfolio risk, we are having nice diversified portfolios. So again, we're putting a good basket of businesses together to manage your portfolio risk. So stay tuned, stay focused. We've got great companies. We're not going to be dislodged. We'll take advantage of opportunities in the market and rearrange based upon also valuations, and just stay focused on the fundamentals, which is what matters. So with that, again, I want to wish each of you a Merry Christmas, a Happy New Year, and look forward to communicating with each of you. Early in the new year, we'll put out another video and update people on the events over the Christmas season, which hopefully will be slow and more relaxed pace. So all the best. Thank you very much for your support. If you have any questions, as you know, you can email, call, stop by the office. Thank you so much. Bye now.